Hey guys, and welcome back to another Elphinstone Research Group Online Academy video. My name is Louis, and today I'm going to be going over the basics of accounting and introducing the three financial statements. Together we're going to look on a surface level of how these financial statements link together, what they are, and go through some of the major calculations and ratios that we use as analysts to understand the company and its financial position. So for some context, let's start with an example of why we use accounting. Company A and Company B are the same in all respects other than a few. They both sell shoes, they're both shoe retailers, and they both made $10 million last year in revenue. They also made $1 million in net income. However, their operating cash flow, which is in the cash flow statement, is different. For Company B, it's negative, and for Company A, it's positive. Operating cash flow is the cash generated by a company's core business operations, which is different from the net income. And the difference actually is down to, if we look at the inventory, it's because Company B decided to buy $1.8 million worth of shoes last year. They thought they were going to sell loads of shoes, and they didn't. Whereas Company A only bought 100,000. They were unable to move this stock off, and therefore this resulted in a negative operating cash flow. Accounting is like the language of finance. The American Accounting Association define it as the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. These users of the information include management to make decisions on how to allocate capital, shareholders and prospective shareholders to make decisions on whether to invest or not, and prospective lenders so they can assess whether to lend the money, whether that company is actually going to be able to pay it back. And of course, consultants, so they can actually offer informed advice to their clients. We can find this financial information online because it is mandated to be disclosed for publicly traded companies. We find this on EDGAR for the US, Company House for the UK, CEDAR for Canada, or you can just go to the investor relation page of the company, or use something like Capital IQ or Bloomberg Terminal, which allows you to export this information easily to Excel. Now, the three financial statements which are required on a quarterly filing or an annual filing are the income statement, the balance sheet, and the cash flow statement. The income statement shows us how profitable the company is, how much revenue it gathered, and how many expenses it had to pay out while making that revenue. And then the balance sheet shows you the financial position. It's not over a period of time, but it's at a snapshot in time. It shows you how many liabilities that company has, how many assets it has, and then assets minus liabilities equals the shareholders' equity. Cash flow statement is the reconciliation of the income statement. It shows you how much cash actually moved. You can either spend cash on financing, you can invest cash, or you can make money from your investments, or you can make money from operating. And those are really the three things that you can do. So to start with the income statement, firstly, we have to understand where the top line comes from. What is revenue? The matching principle requires that revenues and any related expenses be recognised together in the same reporting period. So costs of goods sold are the cost incurred in order to make that revenue. So if I sold a shoe, that shoe costs money to make, or if I'm a retailer, it costs money to buy, and then I sold that shoe. That cost is only incurred once I sell that shoe, and that gives me the gross profit when I take off the cost of goods sold. There are other expenses though that are involved in running that business, including maybe researching new shoes that people might want to buy, and therefore those expenses have to be taken off to find out how much the company made through its operations. There are a few other items though that are not part of the operations of a company, including interest income, which might be made on the cash that that company is sitting on. So those are also added or taken away to get you to the pre-tax income. And then obviously the tax has to be taken off to give you the net income which is the bottom line of the business. Operating expenses that can be taken off, they include typically SG&A and R&D, so that's research and development, or sales, general and administrative costs. Non-operating expenses are costs that are not part of the core business operations, often related to financing or one-off other activities. So, like I said, interest gained or interest expensed, or financial other financial things like forex, foreign exchange gain or loss. Now, as analysts, we look at the margins because they offer comparability. A margin is like a percentage. It's the net income margin would just be how much income you took in over how much revenue you took in. But there are also other ones. You could look at the pre-tax line. You could also look at the EBIT line, which is the same as the operating income. It's earnings before interest and taxes. Divide it by the revenue and gross margin. We use EBIT margin for operating leverage and pre-tax margin. If you want to compare companies that are under different jurisdictions with different tax rates, you might find this helpful. Now, moving on to the balance sheet. The balance sheet shows us assets on one side and then liabilities and equity, the financing of those assets on the other side. Assets are uses of capital, whereas liabilities and equities are sources of capital. Assets can include cash, working capital, property, plant and equipment, intangibles and goodwill. Whereas liabilities and equity are the operating liabilities, the debt, which is taken on, or the equity, which could be the shareholders' equity. Every asset must be financed. Everything on the left-hand side of the balance sheet must be financed by either debt or equity. And this is ultimately why they balance. Capital equity is the residual interest in the assets of the entity after deducting all the liabilities representing the owner's investment in the entity. So that's why the assets minus liabilities is the equity. And so when you own a share of the company, you're owning a share of that equity. Liabilities, however, present an obligation of the entity to transfer economic resources as a result of past events. And this is split between non-current and current. Reading a balance sheet is it depends where it's filed, but in under US GAAP, it starts with more liquid assets or liabilities and ends with less liquid. The most liquid means the closest to cash. The closest thing to cash, of course, is cash. And then accounts receivable, which is cash that's due pretty soon. Inventory, which is you're going to make cash once you sell it. And for debt, the debt revolver, think of it as like the credit card. It's easily accessible debt when the company needs it. Whereas you also have senior secured term debt, which is like a longer term debt financing. Now, when we look at a balance sheet, we can look at two things that are liquidity and solvency. They are slightly different. Liquidity represents the short-term risk. It's the company's ability to pay its short-term debt obligations. There are multiple ratios that are used in defining liquidity, but the most common is current ratio. Current ratio is the current assets over the current liabilities. If the current assets are more than the current liabilities, you're looking good. If they're less, then that means that the company technically can't pay off the current liabilities, that it's due pretty soon. Whereas solvency is the long-term risk. This is most understandable, I think, in the interest coverage, which is the earnings before interest taxes, so a type of earnings over the interest expense. Is the company making enough to pay off the interest on the debt it took on? And then finally, you can also understand the leverage through the balance sheet. Assets are either funded by liabilities and equities, but you can, as to how much liabilities versus how much equity was used, depends on the business. Debt to equity is one way of understanding that. It's dividing that liability versus the equity. You can also look at the interest coverage, which I just mentioned. Now, the income statement and balance sheet link together through retained earnings, because once you've got the profit, you can either withdraw it and pay it out as dividends, or you can leave it as retained earnings. And this retained earnings can either be retained and kept as cash in the balance sheet. It can be used to pay down debt, fund acquisitions, or reinvest into the business. Now, the cash flow statement is the reconciliation of the profit to cash and explains the changes in the balance sheet, linking all three financial statements together. Cash can fundamentally only be used for three things. You can make it, you can use it, or you can raise it. Now, making it is known as operating cash flow. Using it is known as investing cash flow, and sourcing it is known as financing cash flow. The way the cash flow statement is organised is usually using something called the indirect method, which starts with the net income for operating cash flow and reconciles it back to operating cash flow. This involves adding back depreciation as it's a non-cash expense, and then adjusting for working capital, because accounts receivable means more cash that hasn't been collected, and accounts payable is more cash that's being conserved. Therefore, once you take that off the depreciation and other working capital changes, you will get to the operating cash flow. Investing cash flow includes capital expenditures, and financing cash flow includes those dividends that we spoke of, or debt or equity issuance or raising. The net change in cash position is found by taking off the investing cash flow and the financing cash flow from the operating cash flow. And that change in cash position ultimately changes the amount of cash on your balance sheet. Anyway, I hope that video was helpful. This was just a short snapshot of accounting from the context of equity investing. If you have any questions, please put them in the comment section and I'll endeavour to reply to them. If you have any ideas of videos that you would like to see in the future, let us know, and I or Daniel will look into making it. Thank you for watching, and see you in the next video.